everything you need to know about stocks, exchanges, and IPOs. Did you know that the US stock market has never declined over any 20 years in the past century? This incredible fact shows just how powerful long-term investing can be. While the market can be volatile in the short term, patience and a long-term perspective can lead to steady gains over time. My name is Olu, and in today's video, I will break down everything you need to know about the stock market, from what stocks are and how exchanges work, to how initial public offerings, IPOs, allow companies to go public. If you're a beginner, this guide will help you understand how the stock market operates, why it matters, and how to start investing confidently. Don't miss the end of the video, where I'll share some important tips on how to build a diversified portfolio to protect your investments and grow your wealth steadily. So whether you're just getting started or looking to sharpen your investment knowledge, stick around. Let's dive into the stock market and learn how it can help you build wealth over time. Let's start with the basics. So, what exactly are stocks and how do they work? A stock, also known as a share or equity, is a type of investment that represents ownership in a company. When you buy a stock or shares in a company, you're purchasing a small part of that company. As a shareholder, you have a claim on the company's assets and earnings, proportional to the number of shares you own. Companies issue stocks to raise money for various reasons, such as expanding their operations, funding new projects, or paying off debt. In return, they offer you a slice of their company, which can increase in value as the company grows. Let's look at the types of stocks. There are two main types of stocks. One, common stock. This is the most basic form of stock. If you own common stock, you have voting rights in the company's major decisions, like electing board members. Common stockholders also have the potential for higher returns if the company performs well, but they also take on more risk. If the company goes bankrupt, common stockholders are last in line to be paid. 2. Preferred stock. Preferred stock is a bit different. Preferred shareholders usually don't have voting rights, but they do get priority when it comes to receiving dividends. Preferred dividends are often fixed, making this a more stable investment, but with lower potential returns compared to common stock. Preferred stock is typically favored by institutional investors looking for steady income. One of the key reasons investors buy stocks is for potential returns. You can earn a return in two main ways: through capital appreciation, which means the stock's price increases over time, and through dividends, where companies distribute a portion of their earnings to shareholders. Let's talk about the power of dividends. Dividends have played a huge role in the stock market's long-term success. From 1871 to 2023, U.S. stocks increased by 4.7% per year when you exclude dividends. But when you include dividends, this return jumps to 9.2% annually. That's the power of compounding. I believe you understand what stocks are now. Let's explore where they are traded. The stock market. The stock market is where buyers and sellers meet to trade shares of public companies. Stock market, stock exchange, stock index. These three terms are often used interchangeably, but they mean different things. The stock market refers to the overall system where stocks are traded. It's essentially a marketplace where investors can buy and sell shares of companies. However, the market is composed of many different exchanges where these trades happen. A stock exchange is a specific place where stocks are bought and sold. The New York Stock Exchange, NYSE, and NASDAQ are two of the largest in the world. Stock exchanges ensure that trades happen efficiently and fairly, matching buyers with sellers at agreed-upon prices. A stock index tracks the performance of a specific group of stocks, providing a snapshot of the market's overall health. Famous stock indexes include the S&P 500, Dow Jones Industrial Average, DJIA, and NASDAQ Composite. Indexes help investors gauge the market's performance and compare how individual stocks are doing relative to the broader market. The way stocks are traded has evolved dramatically over the years. In the early days, stock trades were done by hand under a buttonwood tree in New York. The introduction of the stock ticker in 1867 and the use of telephones in 1878 revolutionized the market, making it more efficient. Today, high-frequency trading and algorithmic systems have transformed the market even further, allowing for millions of trades to happen in seconds. These advances have made the market more accessible and efficient for individual investors, who can now trade from anywhere in the world with just a smartphone. We should make a mention of the major stock exchanges around the world. Founded in 1792, the NYSE is the world's largest stock exchange, home to giants like Apple, ExxonMobil, and Disney. It has over $30 trillion in listed securities. Known for hosting many technology companies like Google, Microsoft, and Facebook, NASDAQ is the second largest exchange in the world. Its electronic trading system made it famous. London Stock Exchange, LSE. One of the oldest exchanges, the LSE is located in London and is home to thousands of companies from around the world. The role of stock exchanges. Stock exchanges work as big marketplaces where buyers and sellers meet. When you place an order to buy or sell a stock, the exchange matches you with someone on the other side of the trade. This ensures that trades happen quickly and at a fair price. Stock exchanges also have strict rules that companies must follow to be listed. These rules help protect investors by making sure companies provide accurate financial information. Now, this video won't be complete without knowing a little bit about stock indexes. Stock indexes are groups of stocks used to measure the performance of the broader market. For example, the S&P 500 includes 500 of the largest U.S. companies and is considered one of the best benchmarks for the health of the overall U.S. stock market. Indexes like the DJIA, short for the Dow Jones Industrial Average, track 30 large industrial companies, and the NASDAQ Composite is weighted toward tech stocks. Watching these indexes can help you get a sense of how different sectors of the market are performing. How to read stock quotes and charts. Understanding stock quotes and charts is essential for making informed investment decisions. Stock quotes and charts give you the current price of a stock and show how its price has changed over time. A stock quote provides key details about a stock's current price and trading activity. Here are a few important things you'll see. 1. Price. This shows the current cost of one share of stock. 2. Volume. Volume indicates how many shares have been traded during a specific period. High trading volume can indicate strong interest in a stock, while low volume can suggest the opposite. 3. 52-week high/low. This shows the highest and lowest prices the stock has reached in the past year. It can help you determine whether a stock is trading near its peak or at a potential bargain. Stock charts show how a stock's price has changed over time. They usually display price on the vertical axis, up and down, and time on the horizontal axis, left to right. Some key elements to look for on stock charts include trend lines. These lines connect prices over time, showing the stock's overall trend, upward, downward, or sideways. Bar charts. Each bar represents the stock's high, low, opening, and closing prices during a specific period. Support and resistance levels. Support is a price level where a stock has had difficulty falling below, and resistance is a price level where it has struggled to rise above. These levels can provide clues about future price movements. Next is to look at how the stock market works. At its core, the stock market works by matching buyers and sellers who want to trade stocks. Companies issue shares to raise capital, and investors buy these shares hoping to benefit from the company's success. Stock prices are driven by supply and demand. When more people want to buy a stock than sell it, the price goes up. If more people want to sell than buy, the price goes down. This constant push and pull between buyers and sellers is what creates market movements. It's important to remember that the stock market can be volatile in the short term. On average, the market experiences about 3–5% pullbacks per year, and a 10% correction happens roughly once a year. A severe correction of 15 to 20% occurs about once every 2 years. These fluctuations are normal and should be expected by investors. But here's the good news. Over the long term, the U.S. stock market has consistently recovered and grown. In fact, the market has never experienced a decline over any 20 years in the last century. This highlights the importance of taking a long-term approach to investing. Historically, the stock market has provided average returns of about 10% per year, though this varies from year to year. The key to building wealth through stocks is staying invested for the long term and allowing your investments to grow over time. While short-term returns can be volatile, 20-year annualized returns have been much more stable, ranging from plus 0.5% to plus 13.2%. This stability highlights the power of long-term investing. Next is to talk about IPOs. One of the most exciting events for a company is going public through an initial public offering, IPO. But what exactly is an IPO? An initial public offering, IPO, is the process by which a private company offers shares of stock to the public for the first time. This allows the company to raise capital to fund expansion, pay down debt, or pursue other business goals. IPOs allow everyday investors to buy shares in a company from the very beginning of its public journey. But do not get this twisted. IPOs can be volatile. While some IPOs experience significant price appreciation, others may not perform as well if the company fails to meet market expectations. One of the major benefits of investing in an IPO is the chance to get in early on a potentially high-growth company. If the company performs well, early investors may see significant returns as the stock price rises. For example, companies like Google, Amazon, and Tesla all experienced rapid growth after going public, generating substantial wealth for their early investors. IPOs also carry risks. New public companies can be volatile and unpredictable, with their share prices often fluctuating significantly in the early months of trading. If a company underperforms, its stock price may fall, leading to potential losses for early investors. How economic factors impact the stock market. The stock market doesn't exist in a vacuum. It's influenced by a variety of economic factors that can impact stock prices. Understanding these factors can help you navigate market movements and make more informed investment decisions. 1. Interest rates. When interest rates rise, it becomes more expensive for companies to borrow money, which can reduce profits and lead to lower stock prices. Higher interest rates can also make bonds more attractive compared to stocks, leading investors to move their money out of stocks and into bonds. 2. Inflation. Inflation erodes the purchasing power of money, which can negatively impact corporate profits. High inflation also tends to lead to higher interest rates, further pressuring stock prices. However, some sectors, like consumer staples, tend to perform well during inflationary periods because their products are always in demand. 3. GDP growth. The stock market tends to perform well when GDP is growing because a strong economy usually translates into higher corporate profits. When GDP growth slows or contracts, stock prices may decline as investors worry about reduced earnings potential. How do you start investing in the stock market? Step 1. Choose the right account. There are many types of investment accounts, each suited to different goals. If you're saving for retirement, a 401k or IRA might be the right choice. If you're looking for flexibility, a standard brokerage account could be a better option. Step 2. Open a brokerage account. To start buying stocks, you'll need to open an account with a brokerage. Popular online brokers like Fidelity, Robinhood, and Charles Schwab allow you to trade stocks with minimal fees. Most brokers now offer commission-free trading on stocks and ETFs. Step 3. Fund your account. Once you've set up your account, the next step is to transfer money into it. You can start investing with as little as $100 or less. so don't feel like you need a lot of money to begin. Step 4, choose your investments. You can invest in individual stocks, mutual funds, or ETFs. A good place to start is by investing in funds that track major indexes like the S&P 500. This provides instant diversification across hundreds of companies. Step 5, place your order. Once you've chosen your investments, you'll place an order through your broker. Simply specify the stock or fund, the number of shares, and the price you're willing to pay. Step 6, monitor your investments. While it's important to keep an eye on how your investments are doing, don't obsess over daily price changes. Remember that the stock market can be volatile in the short term, but tends to grow over the long term. Building a diversified portfolio. One of the most important principles of investing is diversification. It helps spread risk and reduce the impact of any stock performing poorly. A well-diversified portfolio should include stocks from different sectors. Invest in a mix of industries like technology, healthcare, finance, and consumer goods. A range of company sizes. Include large cap, mid cap, and small cap stocks for a balance between growth potential and stability. International exposure. Don't limit yourself to U.S. stocks. Adding international companies can further diversify your portfolio. A mix of growth and value stocks. Growth stocks tend to have higher potential returns, but come with more risk, while value stocks offer more stability and income through dividends. The right mix depends on your goals and risk tolerance. A simple strategy is to invest in index funds or ETFs, exchange-traded funds, that track broad market indexes like the S&P 500. This provides instant diversification across hundreds of stocks. Experts suggest allocating at least 20-30 individual stocks across 5-6 industries for a diversified portfolio. Another common approach is the 60-40 portfolio, 60% stocks and 40% bonds. If you are interested in finding out about more investments that can grow up your portfolio, linked above the screen is a video on the 7 top monthly dividend ETFs that could outperform the S&P 500. We've covered a lot of ground in this video, from the basics of what stocks are and how the stock market works, to more advanced topics like reading stock charts and understanding IPOs. If you're just getting started with investing, remember to focus on long-term goals, stay diversified, and don't be discouraged by short-term market fluctuations. One of the most compelling insights we shared today is that the U.S. stock market has never declined over 20 years in the last century. This shows just how powerful long-term investing can be. If you're ready to take the next step, consider opening a brokerage account. Start researching companies or ETFs you're interested in, and begin building your portfolio today. If you found this video helpful, don't forget to give it a thumbs up and hit the subscribe button for more investing tips and strategies. Let me know in the comments if there's a topic you'd like to see covered next, and I'll see you in the next video.